What's the biggest mistake US investors make when they're looking at emerging markets like India or China?
Oh boy. Well, the biggest one is they just buy the iShares or Vanguard version. I mean, there's just a disconnect. People think, oh, this is the same thing as the S&P, but it's these companies in India or whatever. Again, it goes back to the very basics. The reason companies have value is because they grow their earnings. And to grow your earnings, you should grow your revenue. I mean, in the long term, you need to grow your revenue. But that's what makes companies more valuable. And if you just buy the index, if you look at what they haven't done either of those things. So that's why I know you can beat the emerging markets index. There is going to be more volatility in things like the internet companies, but I think that this emerging market internet stories, it's just getting started. And
Hey everyone, welcome back to the Ignite podcast. Today, we're thrilled to have Kevin Carter, the founder and CIO of EMQQ Global. He's a pioneer in emerging markets investing, very cool, having launched over 10 ETFs on the New York Stock Exchange and the first India Internet Index. That's pretty interesting. He's collaborated with legendary economist Dr. Burton Malkiel, which had a profound impact on me in college. His book, Random Walk Down Wall Street, so I think we'll get into that. We'll also dive into the rise of digital commerce, emerging markets, look at emerging market investing generally, and looking forward to diving in. Thanks, Kevin, for coming on.
no problem. Glad to be here.
Well, maybe we could start at the beginning. How did you get into investing in the first place?
I graduated with an economics degree from the University of Arizona in 1991, December. And I came home and I thought I'd either get a job in the stock market or in real estate. And my uncle, who was big in real estate, got me a job at a stock market firm, got me an interview actually at a company called Robertson Stevens and Company.
Oh, yeah.
Which we used to call the Goldman Sachs of San Francisco, but now young people think that means the devil. So it was the world's leading technology investment bank. It did all the, IPOs of the early tech companies in the 80s and 90s. Drove into San Francisco in January, and I had one interview at this company, and we basically talked about college basketball for 20 minutes. And then he said, okay, you can start Monday. And I said, well, I don't know anything. How can I start Monday? And he said, well, go buy this book and read it. And I stopped, and he wrote down a Random Walk Down Wall Street. And I stopped at the bookstore on my way home. I bought it, and then I read it over the weekend. And then I showed up Monday. So I didn't really plan it. It was my first interview, and they said, you're hired. And I said, okay, great. And off I went.
That's amazing. Thinking back to when you read that book, you were coming in with Zen Mind, beginner's mind into finance. How did that set you up for how you think about investing? Yeah.
I think when I first read it, there were parts I had no understanding of at all. But there were a lot of things that made sense. I mean, one of the reasons the book is so well known and people like you and I, read it is partially because it's easy to read, and it's kind of a common man's, a lot of it's high level important investing concepts, but Burton has a way of kind of simplifying it down. But I remember the key takeaways where everybody should buy an index fund, right? I mean, in fact, I don't know if you know the details, but the main reason the book is so famous is because in 1973, when Burton first wrote the book, there was no index funds in the world. It wasn't a thing. He wrote 3 paragraphs that started with my idea for a new type of investment fund. And he laid out exactly what, with a fund that would buy all the stocks and just hold them. It wouldn't buy and sell and run up costs, and it would charge a low fee. In fact, he said someone should do it as a not-for-profit. And he specifically called out the New York Stock Exchange to do it. But he said, if they don't do it, I hope somebody else will. And a couple of years later, his friend, Jack Bogle, did, in fact, start Vanguard and the first index fund. So I certainly remember that part of it. But I went to work for an active mutual fund shop. So that part of it, I dismissed a little bit, the idea that you can't beat the market. But, after I read the Berkshire Hathaway annual report, 5 or 6 years later, when Warren Buffett said everybody should just buy an index fund, it kind of blew my brain. And that got me off into it, back revisiting the case for indexing and ultimately connecting with Burton Malkiel, which in and of itself was an interesting thing.
Why do you think an active mutual fund that just hired you would have you read that book?
This is something I still wonder, to be totally honest with you, because not only was it an active mutual fund company, but the person that I talked to turned out to, in many ways, represent all of the bad parts of the mutual fund business. Remember when, I was kind of new, and I don't know, 6 or 9 months into it, they said, oh, we're going to add this new fee, a 12B1 fee.
Oh, right.
And we had brought in a lawyer to work. Actually, they brought him in full time. That was his first project, let's add a 12B1 fee. And I guess one of the things I've been good about all along is just asking questions. And so I said, well, what is this 12B1 fee? And they say, well, it's an additional fee on the investors. It just pays for marketing. It basically paid for my job. Now, the mutual fund business is one of the most profitable businesses in the world. And these, the people running this operation, they have, significant amounts of wealth already.
Billions, if not trillions of dollars under management. They're collecting.
Right. And so the idea that the investors were going to pay, because, I guess the wink behind it was, well, if the fund gets bigger, then we can lower the cost for everybody, which doesn't happen, right? It's not like they go revisit it and say, okay, now we're going to lower the fees because we use this 12B1 fee. It was just adding another kind of hidden fee to what people were paying. And so I don't know why he had suggested that book, but it is worth noting that the founder of Robertson Stevens, Sandy Robertson, who recently passed away, he and Burton were in the same training class together at Morgan Stanley in the 1950s, when the entire company of Morgan Stanley was on one floor of one building, and the entire company of Goldman Sachs was on another floor of the same building. So
it's amazing.
Yeah.
And so Dr. Malkiel won some awards for this. I seem to recall you won like the Nobel Prize in economics. Am I misremembering that?
He certainly would win the Nobel Prize in investment products. He also
won some sort of investing, some prestigious prize.
Oh, he's in almost every sort of, investing hall of fame that there is. And of course, his book has been updated for 50 years. The 50th anniversary edition just came out a couple of years
That's amazing.
ago. And he also, he's been an incredible educator. He taught at Princeton, for decades and decades. He was the dean of the Yale Business School and a longtime Vanguard board member. And he also was in charge of creating the first ETF, the SPDR, when he was the chairman of the New Products Committee at the American Stock Exchange. He's also an amazing, awesome person.
So, I mean, the premise of the book is that you can't beat the market, or most people can anyway, at least over the long term. And so you might as well just efficiently allocate your assets in different asset classes and hit the efficient frontier for risk-adjusted returns and just be happy with that.
Let me say something important. I'm an Omaha person. So while I started by reading A Random Walk Down Wall Street, then I dove into Warren Buffett, Berkshire Hathaway, Peter Lynch, Graham Dodd, Seth Klarman, Phil Fisher. Actually, I worked with Phil Fisher's grandson twice, including at that first job. And so I just absorbed everything I could. But as I tell people, I pray towards Omaha. When I look at anything in the investment world or business world, I look through an Omaha lens. And that's why when I read the 1995 Berkshire Hathaway annual report, when Warren Buffett said most investors, institutional or individual, should just buy an index fund, it kind of blew my mind. And I went back and revisited the reason that he would make that statement. And it became, it was instantly clear that he was right, because if the market goes up 10% and you pay the fund manager 1.5%, you're going to get 8.5%. Now, some people will do better and some will do worse. Collectively, they can't all do better. They will be the market return. And if Vanguard doesn't charge you any fee, or, at least 1% less, then you'll beat the average by 1%. It's just simple math. So anytime I see a mutual fund CEO go on, CNBC and say, well, it's a stock picker's market now, or once this bull market's over, then will really show how good we are. But it's just math. They can't beat the market by charging 1.5%. You're going to underperform. And it was that realization that really led me to question a lot of things about the investment business. And in fact, start my first company, e-investing. Build Your Own Fund was the name of the product, to kind of show you how I felt about the mutual fund industry. So the mutual fund industry for decades was a giant tax on American investors, and the billionaires, through the 50s, 60s, 70s, 80s, the mutual fund guys owned all the sports teams. Now the hedge fund guys, because they charge even more fees than the mutual fund guys.
Right. So, more assets under management. Well, I mean, the market's constantly seeking alpha, right? And, tell us a little bit more about kind of the build your own fund business. How'd that start?
Well, so, I got disillusioned by the investment business. I was working as an analyst and, selling my investment ideas to hedge funds and mutual funds. Janus Capital was my biggest client and paid me a lot of money. And I remember at the end of this 1 year, and I had made so much money and I only was talking about 2 stocks with the portfolio managers in that whole year. And, I got 6 figures worth of commissions just from that firm. And so I got disillusioned with the whole thing. And I took a year off and got married. And I just kept thinking, like, what's with everything that I know or everything that's known about investing, what is the perfect way to do this? What's perfect capital look like? And it was really simple. The first thing you need to do is to invest. And that means you need to start saving money. You need to make more money than you're spending. And you need to take that money and invest it. And if you're going to invest it in the stock market, which is a great way to do it, you should start saving every month. Maybe you can save $500. Maybe you can save $1,000, but you need to just do it, right? And ideally with some kind of a systematic investment plan, right? I'm going to have $500 a month come out of my account and go into the stock market. So that's the first and most important thing. And then the question is, okay, what do I buy when I put my money into the stock market? Well, the problem was if you only had $500, you couldn't buy a stock, right? That back then, in the 90s, if you wanted to buy a stock, if you wanted to invest directly into the stock market without some middleman, you needed the cheapest commission was $29 from Schwab. And it had been $59 not long before this, but now it was down to $29. And the average stock was $30 a share. And you had to buy 100 shares, $3,000 at one time to buy a single stock. Now, I was making a decent amount of money, for someone in their 20s, but I didn't have $3,000 a month at that point to put into a single stock. And some stocks were $50 a share, or Berkshire Hathaway was, thousands of dollars. So because you had to buy 100 shares. And if you bought less than 100 shares, an odd lot, the commission was $79.
Oh, wow.
So the average person had to go into a mutual fund because a mutual fund would absorb, I have $573. And so you were stuck. All these, billionaires with the yachts, they had a stranglehold. And so I thought we have to break that share barrier. We need to let someone buy $5 of stock, right? Or, $8 of Coca-Cola, or $3.52 of Microsoft. So
it was like Robinhood before Robinhood, basically.
Well, I invented fractional share brokerage. I started a company called E-Investing. We filed a patent on this. I should say I thought of it, and then I found the lawyers and operations people that helped me make it a thing. I knew it was possible. And I knew, especially with the network technology where you could pool multiple orders, right? If there's 1,000 people and they all want to buy $5 of this stock or that, then you could cost effectively do it. And again, the product was build your own fund. You don't fire the guy in Boston, right? And then you can invest directly. Now, that didn't solve the question of what to buy, because you could still, am I just going to use this to buy the S&P 500? Am I going to use this to buy individual stocks? That was a whole other thing. And that gets to the active, Vanguard, Berkshire Hathaway, right? That continuum. Now, that's a second problem. But the problem solved with E-Investing and Build Your Own Fund was cracking the share barrier, leveling the playing field so that the average person could invest directly into the stock market without some middle layer.
And so how did that business end up going? Did you end up selling it, or?
Oh, it was so fun. I mean, this is right in the way I met Burton Malkiel was, as I mentioned, I was a young value investor and I was cocky. And this .com thing started, and I was shorting Amazon.com in 1998. And I lost a third of my money in about a day. And the same day, I watched a company called KTEL change its name to KTEL.com. Now, KTEL was a company I knew when I was a kid because when you watched TV, there was only like 3 channels back then. And they were these 1-800 number, you could call and order the greatest rock hits of the 70s.
Yeah, albums. I remember that.
So they did like albums of, different eras and stuff. And it was called KTEL. And I had no idea it was a public stock, but I all of a sudden I heard that KTEL went from $1 a share to $30 a share because they changed the name to KTEL.com. And I found my random walk up on the shelf and I penned, leafed through it, and I found the chapter on bubbles and stock valuation. And apparently in the 1960s, there was a technology bubble and companies were changing their name and adding silicon or electronics so they'd get a higher multiple. And there was a quote from Jack Dreyfus from the 1960s about companies changing their name. I said, oh my God, this just happened. And so I picked up the phone, first I went into the search engine.
Which is hilarious because this is happening again with AI, right?
It's the most sure way to spot a bubble. I mean, there's no doubt. Every time this happens, Burt and I, the Chinese company started, I forget what they did. They started changing their names. The A-share mainland company started changing their names 10 years ago. It was the last time I think we, swapped emails about this. But yes, when companies start to change their names, that's a big red flag just to capture the hype. And so I went into the search engine, which was probably, it wasn't Google. Google didn't exist, but I searched for Burton Malkiel, and up came his Princeton website. And it had his picture and his class schedule and his office hours and his phone number. And I just dialed the phone and he answered. And I said, Dr. Malkiel, you got to see this. It's right out of your book. This company changed its name. The company in the book was called Shoelaces Incorporated. And they said and they changed their name in the book to Silicon and Electronic Firth Burners. And Jack Dreyfus goes in this explanation how it sold for 8 times earnings, but you get to keep doubling the PE, and now it sells for 64 times earnings. And I called him up and we talked and we hit it off. And then when I had this idea, because I knew he had invented the index fund, I said, well, this is better than an index fund. This is, you can build your own index fund if you want, but you cut out that layer. And he said, I like this, and I'll be an advisor to e-investing, but you need to come out here to Princeton. I want to meet you face to face. So I got on a plane and went to Princeton. We had a 3-hour lunch, and he's been my partner on different things ever since then. But so it was, I was such a skeptic on the .com thing, but I'm like, well, hell, if people are going to give me a lot of money, I can build this. This will be, everyone's talking about E-Trade and E-Trading, right? I'm like, we don't need to trade. What we need to do is use this to invest. Let's make E-investing. And I was able to raise an angel round of funding, and we took the cheapest office in downtown San Francisco, ironically on a street that was known as Penny Stock Alley, because it ended at the old exchange, the Pacific Coast Stock Exchange, and apparently it's where the penny stock guys in the 1800s used to gather on the curb. So I was building penny stock investing on Penny Stock Alley. It's called Liedesdorf, is the name of the man who was the big penny stock guy, apparently. But so it was fun. I hired a bunch of tech guys, and I had to find the people that knew how to do this. So I found the most experienced ops guy on the planet who actually had been. I tried to find. There was an ops guy at Schwab, and he said, "You should talk to my dad because I'm not leaving here." His dad had actually signed Michael Bloomberg's first contract, Hank Alexander. So he became my ops guy, and then I had this great lawyer who figured out how we could achieve this. So it was really fun, and it was fast and furious, and we built it and sold it in 12 months. So we sold it to E-Trade in June of 2000.
Amazing.
So it was
right at the peak of the .com bubble.
Well, it was a little after the peak, but no, it wasn't. It was about, the stocks kept going down after that. They were already going down a little before that. But
yeah, I was starting to go down in like March that year, if I recall, and then
So anyhow, it was fun, and I was a reluctant entrepreneur, right? I didn't ever envision myself doing that, but I just thought it had to be made, and nobody else was going to do it, and so we did it.
It's amazing. What are some lessons and takeaways from that experience? I mean, building and selling a startup in a year is pretty crazy.
Oh, man, I don't know. We'd have to do another episode for that, I think. Yeah, I don't want to get big fast. I mean, that's what they told us to do, and people are still. I'm not involved so much with that stage of funding right now, but I just did I'm focused a lot on India right now, and I did a panel discussion with these two guys that do very early stage, like first checks.
Yeah.
In India.
Which is what we do too at Team Ignite. We're very early. Not the first check, but very like pre-seed.
Yeah. So these guys are, kind of the same idea, but they're investing in India. They're actually, one's got family in India, the other one's a successful local founder, American founder who fell in love with India and has moved over there. But anyway, they were talking about their approach, and it's still get big fast, right? That's
that's venture capital, right? I mean, we're investing money so you can get to $1 billion valuation, more or less, and that's $100 million in revenue typically. And what's exciting is companies are getting more capital efficient right now. We're getting some tailwinds with AI, where companies are able to get bigger faster for less money, and I think that's been a long arc of history since the 60s. Like every successive generation of technology makes you more capital efficient. But maybe you talk about selling to E-Trade and how you got interested in India and you started what you're doing now.
Well, we sold the company to E-Trade, and then I didn't have much to do after that because they had all the clients, and I wasn't the one operating the system, and so I left not long after they bought us, and I took a year off and, moved out. We had a baby the same month we sold the company, my first child.
Well, good timing.
Yeah. And we bought a house out in the suburbs. But I kept thinking about, now that we've solved this, okay, you can invest in the stock market. And then the question was, okay, well, what do I buy? And no, I obviously had my Omaha leanings, but it's hard to sort of package up, true Omaha investing in a,
Omaha being like Warren Buffett style value investing, right?
Yeah, I mean, it's how I believe, but it wasn't really a solution for people. And so then it was, okay, well, let's use this so people can make their own index fund. So we started this thing. People call it direct indexing now, but when Burt and I invented it, we called it active indexing. So the idea was, look, now you start with we'll make you an S&P 50 portfolio. It'll track the S&P, but it's a miniature. If you had fractional shares, you could buy 500 stocks, but you probably wouldn't want to. Your statements would be long.
Oh, yeah, it's like a compressed S&P 500.
That's right. It was a
you pick and choose 50 stocks of your choosing.
What we designed was a way that you could track it. You could take the 500 and shrink it down to 50 in a way that would track the S&P as close as possible. Right, that's the main goal. We're going to give you the same as the S&P. You're going to be off for 1 or 2% depending on which exact stocks you have.
Well, I think recently you'd be off even more if you weren't in the FANG. That
was
Mag
already
7, right?
It's funny because there were before we launched this is now almost $1 trillion. People told us we were crazy when we started this, but this direct indexing thing is now almost $1 trillion a sector, part of the wealth management business. And so, but before we, because we invented this 25 years ago, now it's everywhere. Schwab does it and Vanguard does it. They call it has different names, personal indexing, whatever. But so we thought, okay, we can shrink it down to 50. But there and we did thousands of simulations of this, and there were certainly ones where most of them were plus or minus 1% of the index. But back then,
what's the benefit to the investor here versus just buying the Spider or
two things,
any 500 index from Vanguard or whatever?
Two things, well, maybe three things. The first is you can customize. So you don't want to own tobacco stocks or alcohol stocks, right? Before we had ESG, they called it socially responsible. So you could do those things. A lot of investors wanted to do those things. You also had situations where, I'm on the board of Intel, so I don't want to leave Intel out because I don't want to, right? Which is a problem for other people doing separate accounts. But the main problem is taxes, because when you own the stocks directly, if it's a taxable account, you could do loss harvesting. So let's say we own General Motors for year 50 and the auto sector goes down. Let's sell your GM and take a loss and replace it with Ford. And then at the end of the year, you'll have the same return as the index, but you'll have losses, which have value. So the idea, it was a math trick. You can beat the index, and it's worked incredibly well. We theorized that we could beat the index by 1.5 or 2%. This has 20 years of live audited track record. Now it's more than that.
Just with some of these tax harvesting rules and, compression on the index, things like that.
Yeah, with basically the tax loss harvesting. Losses have value if you're a taxpayer. So you get the same return, but you squeeze out these losses and you save $2,000 on your taxes. You invest that back in the stock market, right? And the miracle of compounding, makes it even more. So those were the reasons, customization and taxes. And so we built this business. I hired a bunch of iShares people and my tech guys from my previous company. And again, people thought, no, why would you do this? It's a high cost index fund. By the way, the other reason is an open-end index fund is a tax disaster, right? The embedded capital gains, ETFs are better, but you mentioned index funds, open-end Vanguard funds. If taxable money in those things is not a good idea because they've got half of the NAV is somebody else's gains. And if they sell that as stocks, you get taxed on that. So
unless you're in like a 401k or a Roth or
retirement
like
account, doesn't matter.
Yeah.
But so what happened was we built this business, we sold it, we got acquired by a French company called Natixis, which is a big mutual fund holding company in Boston, ironically. But just before we sold the company, Google went public. So this is the fall of 2004. Actually, we sold the company, closed in December of 2004. But a few months before that, Google went public, and they asked Burton to give a talk to their employees about
I
investing.
think I've seen that. They recorded that, right?
They, I think, did. And I think it was Bill Sharp and Burton.
Yeah.
And I wasn't invited, but I had dinner with Burton the night before. And, everyone was talking about the Google IPO. It was a kind of a funky IPO, the way they did it. And a few months later, my phone rang. And it was a guy from Google. And he said, hey, I heard about this active indexing. I want to invest. And I said, okay, well, who's your advisor? Because we just worked, we worked with people at Morgan Stanley, Credit Suisse, Deutsche Bank. He said, well, I don't have an advisor and I don't want an advisor. I want to just, I know what I want. I heard about this. I understand it. I want to put money in this. And I said, okay, well, I'll come have lunch with you. So I drove down to Mountain View. Yeah, 22 years ago, whatever. No, 20 years ago. Might have been 20 years ago today, frankly. I drove down to Mountain View and I sat down with this kid and explained what we did. And he said, okay, well, how much should I invest in this active S&P 500? And I said, I don't know. How much money do you have? And he said he had a lot. And I said, okay, well, that's good. You're rich, so you should be conservative. But you're 25, so you should be aggressive. And, I don't have a pie chart with me. I don't have I don't know what the standard allocation is to the S&P 500 for a moderate investor. We'll call you young but rich, so we'll call you moderate. I said, maybe you should put 20 or 25% in this, but we'll figure it out. And he said, well, what about the rest of my money? I said, I would just buy the cheapest ETFs. And he said, well, can you do that for me and take all my money? And I said, sure. So I started going back and forth to Mountain View in the spring of 2005, and I ended up with about a dozen different Google people.
Because they're newly rich and they're trying to figure out what to do with all this money. A lot of these employees are sitting on millions, if not tens of millions of dollars.
It was so fascinating because they were all in their 20s. They all had a lot of money, but some of them were from Eastern Europe. I mean, they were all engineers, though. And so the first person I sat down with, I said, what do you do exactly? And he said, well, when you misspell a word, and it says, did you mean? That's what I do. I did that. I said, oh, okay. I said, well, what do you want to do with your life? He said, artificial intelligence. First time I ever heard that. And then I said, okay, well, do you want to leave out tobacco or alcohol or anything like that? He said, I never want to own Microsoft. That's my favorite part. So,
oops.
Everybody, ESG, everyone, this is why it's hard to pre-package these value-based things into a single product, because not everyone has the same set of particular issues. But and then the other people that he introduced me to were also, these are people that are big in the AI world now. They stuck with that, and now they're in the paper sometimes. But
right place, right time, yeah.
But so I started going to Mountain View 20 years ago right now. I started going like every week to meet some new engineer, and Burton started going to China. So two of his Princeton economist friends were Chinese professors. They were economics professors from China. They went back to teach in China around the year 2000. And they said, Burt, you need to come see this. China was growing at 10, 11, 12%. And so he started going to China when I was going to Mountain View, and these guys and him wrote a white paper about investing in China. And Google called me and said, hey, can Burton come talk about China? I said, okay. And 20 years ago, I picked up Burton. This was in the spring of 06, I guess. So 19 years ago, I picked up Burton down by the San Francisco airport, and we drove to Mountain View. He gave a talk about investing in China. And when he was done, these people looked at me and said, we want to invest in China. And literally from that moment until today, my entire life has been trying to figure out what does that even mean,
right,
to invest in
there's
China.
Lots of unique challenges with China versus India. So maybe you could talk about a little bit of that and how you want to about that.
Sure. Well, the first and most important thing is that the problem with emerging markets is the indexes themselves are terrible. So after Burton's talk, we drove back to San Francisco, and I went straight over to our portfolio managers and I said, give me a list of all the companies in the China ETF, because I assumed for these Google people, we would just put some money into the China ETF. There was only one China ETF in the world that day, and the FXI is the ticker. It's an iShares fund. And I wanted to see the list of companies because I'm an Omaha person. I don't care about the name of the fund. I want to know what are the businesses we're going to own. And that's when Burton said, Kevin, when you see the list of companies, they're going to be largely Chinese government-owned banks and oil companies, which didn't sound good at all. But then he explained that, not only were these inefficient companies, but they were corrupt almost always. And even if they weren't, they had no interest in growing their earnings the way a normal company does. And that made me sick to my stomach because, in Omaha, this whole thing's really simple. The reason a company has value is it makes profits for the owners. And the only way to grow the value is to grow the profits. And you're telling me that these companies don't care about that? Like, why would you possibly invest in a company that doesn't care about growing their profit? So I got the list of the companies for the China index. It was 80% government-owned banks and oil companies. So I was like, well, wait, this makes no sense. So that's the biggest problem. The broad indexes are only about 30% state-owned enterprises. India is only about 10% state-owned enterprises. And the other problem was Baidu wasn't in the index. So we called iShares. We're like, how come Baidu's not in the index?
It's trouble understanding. So if it's a state-owned, how do they trade their stock? Is it just partially state-owned or majority state-owned?
It's controlled by the state. The state's the controlling shareholder.
Got it. Okay. So they own the majority of the asset and they float some of the shares out there.
It's almost always banks, oil companies, Petrobras. The best example of this is the state-owned oil company in Brazil, Petrobras. And, for over a decade, the leaders of the country had a 5% kickback built into every contract. And it almost toppled the entire country. I mean, they were on the edge of civil war inside of Brazil.
Well, yeah, because if you're a political leader and getting 5% on all the oil revenue, that's a lot of money.
It was mainly on the construction contracts, which were massive.
Right.
But it literally was two of the presidents and about a third of their Congress people. Operation Car Wash is how it's amazing. There's a movie about it called The End of Democracy or The Edge of Democracy. Problem is, even when they're not getting ripped off, gas prices are too high for Brazilians. So the government says you can't charge so much. They can't win. And the temptation for theft and other corruption is real, and it happens. I mean, you take any state-owned enterprise and add the word scandal and put it in Google, and you'll have plenty of reading material. There literally may not be a single state-owned enterprise that hasn't had some sort of financial scandal, oftentimes enormous. So let me get back to the India-China thing. So what I concluded pretty early was you can't buy the index, and that what you really ought to do is just focus on the...
What do you mean by that? You concluded you can't buy the index?
MSCI index, the iShares China or the Vanguard emerging markets.
You can't or shouldn't?
You should not. If you want to make money, if you want to have your money do nothing, then you should buy them.
Got it.
And here, the revenue growth for the MSCI emerging markets index in the last 10 years, it's gone down. The earnings have gone down. So people look at these emerging markets and they say, well, there's all these people and they're younger and they're faster growing. There's got to be a great way to invest. And the PEs are really low. It's half the price of the S&P 500. Well, do you know what the Agricultural Bank of China is? Have you, watched this movie about Brazil, and then you'll know why you don't want to buy Vanguard or iShares traditional things. What you want to do is get targeted. And I watched this, that my first 10 years investing in emerging markets, I spent most of my time in New York and Boston with endowments and foundations and family offices. I launched several China ETFs with Guggenheim that Invesco now owns, but I spent my time in Boston and New York. And I watched how people like Harvard and Yale were doubling their emerging market allocations, but getting more targeted. David Swenson at Yale could take his smartest Chinese alumni and give him $100 million and tell him to go home and start a private equity fund, which worked great. Most people couldn't do that. So when people would ask me, what's the best emerging markets ETF? I didn't tell them to buy one of my China ETFs. I told them to buy the emerging market consumer ETF. The food companies, the clothing companies, the Walmart of Mexico, right? Those kind of companies, because that's the real story. The thing that's emerging are 6.5 billion people, and they want more food, better clothing, heaters, air conditioners. They want to go to a movie, take a vacation, get on an airplane, buy a car, and have their kids go to Harvard. And I didn't have to figure that out either. That was very well documented 20 years ago when I got involved. McKinsey calls it the biggest growth story ever. So you leave out the legacy, you just focus on the consumer. And basically 11 years ago, someone called me and asked me, what's the best emerging markets ETF for my child's college fund? And I answered that call on this smartphone. My very first iPhone was sitting on my car seat. And I started to tell her to buy the emerging market consumer ETF. And then I went, wait a minute, that's not the answer anymore. And I went straight back to my office. And I launched EMQQ 3 months later on the New York Stock Exchange.
Amazing. And maybe break down what that is.
Well, it's the emerging markets internet sector. So what I realized was you wanted to own Amazon. You didn't want to own Sears, right? Is basically what it came down to.
Kind of cancel each other out in a way.
Because here's what specifically happened. Do you know the company Mercado Libre?
I've heard the name.
Okay. Mercado Libre is one of the most dominant internet companies on the planet. It is the Amazon.com of South America. It owns South America, Brazil, Mexico, dozens of Latin countries. Mercado Libre is number one by far. And that the morning that my friend called me, I was looking at my own stocks, and I had 5 stocks that were all part of this consumer story in emerging markets. One food company in China, Want like Nabisco. 2 clothing companies in China, Li Ning and Peak Sports like Reebok and Converse, so food and clothing. But then I had the Craigslist of China, Wuba, which had a 94% gross margin, highest I've ever seen. And And then I had this company, Mercado Libre, the Amazon.com of Brazil. But Mercado Libre was called a technology company. So it wasn't part of the ETF I told people to buy. And I realized was that this device was changing consumption and the database wasn't catching up fast enough. That Amazon wasn't a tech company, it was a consumer company, but not according to the database. So that's why, and these companies were growing 5 times as fast as the traditional food and clothing companies. Now, in hindsight, it really wasn't a stretch. If you watch CNBC, not that I do that regularly, but every quarter, they'd say, here's all the traditional retailers going bankrupt. Oh, here's the FANG stocks taking over the world. Well, the same thing was starting to happen in Brazil, but I had watched it already happen in China. I actually, before I launched EMQQ, I launched with Guggenheim CQQQ to capture the story in China. So a lot of people know this ETF K-Web, which invests in China internet companies. I launched CQQQ 5 years before that. The K-Web guys just did a much better job marketing than the Guggenheim people did. They were more of a financial engineering company than a real growth company. But so
you caught the right idea at the right time, basically, right? These emerging markets were growing super fast, especially software technologically enabled businesses. And so why not create an index that targets those stocks?
Well, here's what I didn't realize it at the time, but it's very clear to me now. What we invest in is one of the biggest deals ever. I mean, this is something huge is happening in emerging markets, and it's a combination of 3 mega trends happening at the same time. The first one is 6.5 billion people want all the stuff we have, the emerging market consumer. I was already focused on that. The second mega trend is called the computer. Now, when I got that call 10 years ago, I answered it on my first iPhone. So I had a smartphone 10 years ago or 11 years ago. I had a computer for 20 years before this. Well, guess what? Most of the world is getting their first computer today, and it's not a desktop, and it's not an Apple product. The Android-based smartphone is sweeping the planet at an incredible rate, and it's bringing the computer to the world for the first time. Every year it gets better, and every year it gets cheaper. You can now get a brand new smartphone in India for $12. So one of the big differences while we're on this, and China was at this point, India's kind of like China was 15, 20 years ago. But when China was at this point, nobody on the planet had a smartphone. And in the 15 years since, or 20 years since I got involved with China, this, not only did this device show up, but think about how far it's come in the last decade or 2 decades. And so India's coming into its growth curve where you can literally get a pocket-sized supercomputer for $12. Now, the third mega
ubiquitous access to all human knowledge, AI, creation tools, everything. Yeah.
Yes, and in India, it's even better than that. But the third mega trend in this story is called the internet. I got the internet in 1995 in the Marina District of San Francisco on a telephone line with a modem.
Right.
Didn't work.
I was there. I was a teenager, but I do recall.
There wasn't a lot you could do on the web, and it didn't work well, and you were frustrated frequently, and it was slow, but you could go on. So, well, guess what? The world's never been wired with high-speed cable. So when 7 million people this month in India alone get their first ever smartphone, it's their first computer and their first internet access. And because these people have never had a bank account, there's no Target stores, they don't have a car, they're leapfrogging. And in many ways, they're more digital than we are. And the result of this is the fastest growing sector on the planet, maybe. In the last 15 years, the EMQQ sector, the emerging markets internet sector, has averaged revenue growth of 35% for 15 years.
It's a lot of compounding.
A lot of
doubling
compounding.
Basically every 2 years for the last 15 years.
It has been an incredible growth story, but 80% of it has been China so far. So if you think about the internet, like when did humans first get the internet? And when could they go onto the internet and buy something?
Yeah.
Or do some kind of business, find an apartment, sell a used bicycle, buy a plane ticket, trade a stock. That basically started in the year 2000 when people had personal computers at their homes or their apartments, internet access, and things they could do. I probably was an early adopter. I was shorting Amazon, for example, in 1998. But let's say that started in the year 2000. And what did you see happen? This incredible S-curve of growth as the FANG stocks took over our lives and our stock market. First on PCs, then on smartphones. That was the first wave. Still going. Maybe an AI boost. The second wave was China right behind us. Alibaba and Tencent, right? Baidu. And that was the second wave. Now is the third wave. And the third wave is all of the other emerging markets, right? So a lot of people don't want to invest in China for different reasons. But the fact is, China's an emerging market in a traditional sense. But when it comes to the internet and smartphones and e-commerce, it is by far the most developed country on the planet. No one else is even close. It dwarfs the United States, and China's e-commerce market is 4 times bigger than every other emerging market combined. So it's already happened, right? Alibaba and Tencent, they can't grow at 30% anymore. So the other emerging markets, South America, Southeast Asia, India,
and Africa too, right?
And Africa, that's a more frontier market. There's a couple of emerging markets in Africa, but most of the people live in so-called frontier markets, or even countries that aren't even categorized. You have to have a stock market to be
emerging market. Okay.
Well, in the MSCI universe, right? If there's no stocks, then there's no designation. You're just out there. So we'll call them pre-frontier markets, a lot of Africa. But India stands alone. So India is as good as you're ever going to get as an emerging market investor. And here's why. If you look at the reasons to invest in emerging markets, the list is this. Lots of people, better demographics, faster growth, driving consumption.
Lots of upside, basically.
But basically, yes. I mean, implicit in the word emerging is some kind of growth. So if you leave out China, India is bigger than every other emerging market combined. So it's big. It's the biggest.
Basically, how many years behind China? Like if we kind of look at it and we consider the differences in technology now versus when India versus when China emerged, we think what's the window here for India?
I'd say it's 10 to 20 years behind, depending on the category. Infrastructure, I'd say 20.
It's a really good place to invest right now.
Well, for long-term investors, I can't think of a place better. And I don't think there ever will be, because this can only happen once, theoretically. And once you emerge, once you're developed, you did it.
Yeah.
Right? And so India's got the largest population. Today, it set a record as the largest population ever. Tomorrow, it'll set a record as the largest population ever. Every day for decades, that day, it will be the largest country ever. China's demographics are now more like a European country. It has the best demographics. It has twice as many people under the age of 30 as our whole population. The average age is 28 and a half. The dependency ratio of young to old is incredible.
So how do you think about this if you're advising someone like us, an early stage VC that does invest globally? How do we maximize our chances of hitting home runs in an emerging market like India?
Well, the first thing you'd have to do is be there. It's not, setting up shop in India is not as easy as other places. And I can't speak specifically for venture capital formation businesses, but I think it's a little challenging, but I think I'm trying to find a good fund.
Basically, just be there and invest in lots of companies.
You know what? You should have as a guest that my two friends at 2 a.m. VC, which are doing first round checks.
Yeah, that'd be great. Yeah,
they're great guys. It's a fascinating story. That Herschel Mehta grew up here in the United States, but he's got a family in Mumbai, including an uncle who's one of the most prolific angel investors in India. And then his partner is Brendan Rogers, and Brendan was a Silicon Valley entrepreneur. He started the dog walking app Wag, and that company I think became public. And him and Herschel had met before the COVID and hit it off. And basically, Brendan dropped everything, and he's all in on India. He's moved there. I mean, he's there.
Oh, wow.
They're going back and forth between the States and India. And it's fascinating. I just did a call with them, this or webinar event with them this week. And so they're the guys to answer that question. That's how I would start. If you were going to ask me the question, I'd say talk to those guys because they're doing it. And they've had some very good, Herschel and his family have a one investment right now that's an amazing business. One of the single most exciting e-commerce company in India today that's still private, called Zepto, which these are two Indian kids that dropped out of Stanford when they were freshmen, and they've got a business now that's worth at least $5 billion.
So what do you think about this dynamic of private versus public markets where companies now are capturing a lot more of the gains than they were, 20 years ago privately, and then going public kind of when growth stagnates and kind of the private markets dry up. So companies used to go public at 500 million valuations, and now it's like more like 5 billion or 50 billion even.
Yeah, there's a lot of things that have been evolving in the last 50 years in terms of financial markets. I mean, there's still some places you have to be profitable to go public in some countries still. and have years of being profitable. India right now has some small and mid-size IPOs happening. So it depends, but the trend you're talking about is obviously very true and pronounced. And, you have liquidity for private companies now. You have, mutual funds are investing in private shares. So it's certainly changed, but I don't think that these companies that go public, that there's no skin on the bone left, that there's nothing left for the public shareholders. I mean, look at what Facebook's done since it went public. I mean, I don't know. I mean,
the counter. There's lots of counterpoints, like Stripe, right? Still a private company, probably worth $100 billion. SpaceX, another great example. I think famously the Stripe founders were on the Ellen podcast last week, and they basically said, I don't think we're going to go public. I don't think we need to.
Well, that's a whole other thing. I mean, one of the most valuable unicorns in India is the online brokerage firm Zerodha, which was bootstrapped by two brothers. And I think they are, I think, literally making more money than every other startup combined. So, they probably will never go public either. But this company, Zepto, I mean, their business has happened so fast, they haven't even had a chance to even think about going public, because it's had staggering growth,
So imagine I'm sold on this India idea. I think it's the India century, as McKinsey has called it, and I think you're on board with that. So why would I invest in the INQQ? That's your index for internet companies. How is that constructed? What should I know about it?
Okay, well, first of all, one thing we have to talk about, so I'll answer your question, but we have to talk about the India stack, because India has a secret weapon that you and your listeners will find very interesting, which nobody really understands it, but it's digitally related, and it's hugely important, the India stack. But look, the internet companies are the best way to invest in all emerging markets. And the reason is it's where the growth is, right? You don't have to look very far. Just look around where we are with our stock market and our lives. Consumer internet, Apple is part of the hardware, but the FANG stocks in general, it's the same story. And it's happening in India now. And it's early. In almost every vertical, the growth of like food, for example. Okay, online food ordering, $10 per annum today in India, $250 in China. So these subsectors can grow 500% and it'll still be early. The other benefit of these companies is not only is it definitely where the best growth is, it's also definitely where the best corporate governance is, because corporate governance is one of the biggest problems in emerging markets. The state-owned enterprises, forget about them, they're a disaster, but the Adani Group, the Chaebols, these 10 different related companies, and this company owns part of that. You don't want that. The way these internet companies look is almost always the same. The smartest kid from every country goes to the best colleges. And in the case of the Indian internet, it's IIT Delhi or IIT Bombay or IIT somewhere else, or it's IIM Ahmedabad, the Harvard and Yale of India. By the way, there's 25 S&P 500 CEOs that have gone to these colleges. So, right? Think about that, including Google and Microsoft. And then they go to work for Google or Microsoft after they graduate from IIT. Then they get their master's, and then they get funded by Tiger Global or Sequoia. And the founders are still running the companies. And so that doesn't guarantee better corporate governance. But if Sequoia is your first round investor, the paperwork's probably cleaner than the Adani Group, right? So that's why it's set up. That's why we made INQQ, and it is happening. And the one thing, it's so early, like this is going to go on for 20 years in India. The other thing that people don't appreciate about India, the human capital, which I just referenced a little bit, the digital public infrastructure that India has built is an absolute game changer. And I'm going to emphasize this, and maybe you can edit this out or edit this down so that you conclude this, but this is very important. Are you familiar with the India stack?
Tell us about it, yeah.
The India stack is a secret weapon, and I know this because I talk to investors all over the world, mainly in the United States and Europe, but it's what I do. And so I ask people, do you know what the India stack is? And not one person has raised their hand. So this is why I say this is a secret weapon. Nobody really knows about this. And if you go back to...
they're about to, because we're gonna tell them right now.
If we go back to Burton Malkiel and the efficient markets, is everything that's known is reflected in stock prices. Well, obviously, people in India know about the India stack, but the average investor doesn't. So here's what it is. The India stack is India's homemade digital public infrastructure, DPI. Now, that sounds really boring. Let me explain what it is. We use digital public infrastructure every day, including right now. the internet is digital, it's public, it's free, right? And it's like the roads or tunnels or bridges of the information age. Okay? The internet. GPS. I didn't launch a satellite. You didn't launch a satellite, but now I can go out push a button and a car will pick me up and bring me to the airport. I don't even have to talk. So not only do we use it, Uber uses it. Uber doesn't get a bill from the the satellite company, right? We don't even know how it happened, but it's there. India has the internet and it has GPS. It's also got some other layers and it's absolutely genius. And the foundation of this stack, the first layer is called Aadhaar. That's the Indian word for foundation. So the foundation is called foundation and it was launched in 2009, and it's a digital identity system. So one of the problems India had in developing was that less than 20% of the people had any form of identification. And so it's half the people didn't even know their birthday because they didn't get birth certificates, right? And so it was this very informal economy. It's a lot of things it's hard to do if you can't prove who you are. So in 2009, they decided they finally had to address this problem. And they launched basically they set up an organization, Aadhaar, that would give everybody in the country a physical identity card, like a driver's license, right? I mean, their picture, their name, and their information, and their own 12-digit number. So everybody in the country would finally have an identity card from the government. Well, they asked a man named Nandan Nilekani to oversee this. Now, Nandan Nilekani is well known in India. He's one of the founders of Infosys. He's a multi-billionaire, and he's currently the chairman of the board of Infosys. They asked him to lead this program to give everyone a physical card. He agreed to do it, but he said, if I'm going to do it, we're going to use a lot of technology. And when they launched in 2010, when people went to register, they scanned their eyes and their thumb so that every 12-digit number could be linked to that human being. 2010 is when they launched this. This was all voluntary. It wasn't like they came around with the army and made you go, it wasn't Big Brother. They achieved this ingeniously by letting capitalist forces set up and operate the places where you'd register. And I knew about this program when it launched, and I added the logo to our coming soon slide because there wasn't any Indian stocks for us to own for many years. I didn't pay attention to this program until 4 years ago, but they launched it in 2010. And I was stunned when I realized that 95% of the entire population is now in this biometric database. So not only do they have a physical card, but they can be instantly verified as who they are with a camera or just a thumbprint, okay? And I didn't know until 4 years ago that in 2014, they opened a program with the banking system and said, if you're in the database, you can walk into a bank with no paperwork and instantly open your first ever bank account, a digital bank account, in 2 minutes with your thumb and looking in a camera. 800 million people in the last 10 years walked into a bank and opened their first ever bank account. Their entire lives were paper-based currency.
Right. Yeah.
And you've used this genius ID layer to bring the entire country into the financial system. Inclusion at scale. In 2016, and 2016 is the year where all of this ignites, if you will. So they passed 1 billion people in the database in April of 2016. Later, a few months after this, Reliance Industries launched the first 4G network in India, Reliance Jio. Now, they spent $25 billion for the 4G airwaves, and they covered the entire country with brand new state-of-the-art hardware, ready for 5G. At the time, there was 12 mobile carriers, all of them on 2G. And they were all in a price war. None of them had any money to even invest in 3G. And this is right when the smartphones started to get to the price point where Indians were buying them. Jio launches, they have big goals. They want to get 100 million people in the first year, which sounded outrageous because if you went into the Vodafone store or the Airtel store, it would take at least 3 hours and maybe 3 days to get a new phone. The entire India stack has got open APIs. Jio used Aadhaar. When you went into the Jio store, it took 5 minutes because you just looked in the camera and put your thumb down. So they now have 500 million people on the Jio network. India data is the cheapest on the planet. We pay 50 times as much for a gigabyte as Indians. The Indian smartphone uses more data than any other smartphone on the planet now. So you've used this database, this ID system, 800 million people into the financial system, 500 million people onto the internet, 5G, cheapest data in the planet. That same year, they added a payments layer. The second layer of the stack is a payments layer called the Unified Payments Interface, which is instantaneous, free transfer of money, like sending a text.
So everybody got like a free version of Venmo, basically.
It's so you can take the money out.
It takes 3 days or whatever. Yeah.
Same general direction. I could send you 1,000 rupees. We could send it back and forth 1,000,000 times. It would instantly go from one to the other, and it would never always be 1,000 rupees. Now, they also simplified the tax code, and they took 80% of the currency out of circulation at the end of that year.
Forcing people into the digital banking system.
Yes.
More or less, yeah.
And the UPI numbers now, the 15 billion payments are processed a month on UPI. That's half of the entire world's instant real-time payments. And the entire Indian economy went from in 7 years, 95% paper-based currency to 80% digital. The tax collections have exploded. They're growing faster than the economy, which is paying for the infrastructure. And this is just 2 examples. They have digitized everything. You can walk through airports now. You can, now that everyone has a financial track record. Nobody in India has ever been able to get credit. Well, now you've got all your data. And they have another layer, the account aggregator, that lets you, in an encrypted way, share your data with credit providers to get a credit card or a loan. So this India stack, there is no other country on the planet that has anything like it. And I'm telling you, it is worth a lot. This is like $1 trillion asset, probably more.
It sets the country up for a lot of entrepreneurship and company creation. And
the number of startups I didn't go so deep into the human capital. I talked about the Microsoft, and Google CEOs, but India has a technology sector that's older than I am. I mean, Infosys, Tata, TCS, these companies have been publicly traded for decades. They've employed 1 million plus technologists and managerial talent in India, all that speak English in that sector. You now have an explosion in entrepreneurship. 7 years ago, there was 500 startups in the entire country. 7 years ago.
7 years ago, wow.
500. There's 120,000 today.
Amazing.
The kids that used to want to stay here, and they're going back to India. The founders of Zepto left.
I have some friends here in the Bay that have gone back.
So this is hugely important. They have their own Shark Tank now, right? Season 4 going on right now. So this mind shift is so important. Having great human capital is great, but if it all comes to Silicon Valley, right? And it used to be if you stayed home, you wanted to work for the government, right? That's the most stable income. Now that's gone. And so the entrepreneurship has also exploded. Again, you should talk to Brendan and Herschel. I'm sure you'll find what they have to say.
Yeah, that'd be amazing. Yeah, so it's set up for a very strong, 10 or 20 year run, basically.
I think so, because it's so early. But and again, I know you can edit this out. So let me tell you about Quick Commerce. I spent most of November in India, and Quick Commerce this is the greatest show on earth right now, in my opinion. Do you know what Quick Commerce is?
No, maybe you can explain for the audience.
Quick Commerce, as it sounds, is really fast delivery of something you want to buy. And call it 10-minute delivery of anything. So the simple way to think of it is 10-minute delivery of anything. Now, this is a business model that started to show up around 2020, 2021. There was kind of a bubble in the venture space in emerging markets, but the world's leader in this is in Bogota, Colombia, Rappi, which is one of the biggest unicorns in Latin America. So I went to Bogota just to see Rappi and see its operation, this quick commerce idea. But basically, it's 10-minute delivery of anything. And the way it works is, first of all, you need dense cities, large populations living densely, and you need cheap labor on 2-wheeled vehicles, motorcycles, bicycles, etc. And instead of having a big warehouse every 10 miles, you have a small warehouse every half mile, a dark store, a mini warehouse. So it's really kind of reconfiguring the last mile supply element. And it works. And in India, it is absolutely exploding. And there's 3 players right now. And I'm pretty sure there's going to be these 3 players all the way through this. But the biggest is called Blinkit, Blinkit, which is owned by the DoorDash of India, which is called Zomato, which is the traditional, food delivery from restaurants. They acquired Blinkit 2 years ago, and Blinkit Quick Commerce is going to be bigger than their food delivery business. It's become very clear. The second company in this is Swiggy, which went public in November. they're the number 2 in food delivery. Now they're the number 2 in food in quick commerce. And then the third one is the pure play Zepto, Zepto, which Herschel Mehta, who you'll hopefully have on, it was one of the earliest investors in. These are the 2 kids that left Stanford. Zepto's the only pure play. Now, so again, the way this works, you're going to set up a micro warehouse, a miniature warehouse that's going to have 10,000 items. It's going to be every half mile to a mile. You get on your phone, it's going to know what the local, what's available in the local dark store, and they're going to refine the assortment based on neighborhood needs and seasonality and so forth. And you're going to push the button, I want these potato chips and whatever else. It's going to take 1 minute and 40 seconds for that to be put into a bag and ready for pickup by a delivery driver on a moped who's going to grab it and whisk it over to you, and you're going to be less than, a mile away. And then he'll repeat. This is absolutely exploding. And the reason this is such a big deal is right now, they don't have, they have traditional formal retail, but not many, and it hasn't really stuck. You have 13 million mom and pop corner stores that have 150 or 200 items, the Kirana stores. And it's literally $550 billion a year spent in this incredibly fragmented, informal retail. And it looked like these Kirana stores were going to get digitized, and they are getting digitized. But they are now in great danger because this sector is expected to grow 700% in the next, or 600% in the next 5 years. Like, the numbers are staggering for the growth, and they've barely even left the tier 1 cities. So this is a greenfield land grab, and it's changing consumer behavior because the Kirana only has 200 items. Your phone's got 10,000 items. And it's fascinating. They're trying different things out. I mean, this is so greenfields. For example, just a couple months ago, I think it announced they're now offering 10-minute private ambulance. You need an ambulance? Just blink it, right?
That's amazing.
Seasonally, they have gold coin. I was there for Diwali, and we were selling assortments of Diwali gifts and candy. So again, you can refine the offering for the particular neighborhood and the different seasons and so forth. In the last month, there's one of them, I can't remember which one is offering, you can buy a brand new Suzuki Maserati automobile in 10 minutes. Zepto didn't match that, but they now offer 10-minute test. You want to test drive a Suzuki automobile 10 minutes.
That's amazing.
So it is really, this is a huge deal, and it's really early, and it is, in terms of, I know AI is a big thing, but it's not something you see on the streets, if you will. This is like hand-to-hand, combat at huge scale of India's, retail consumption market, and it's very early.
That's amazing. Well, why don't we wrap up with a rapid fire? Because I had a few burning questions I wanted to ask you before I let you go. So, given all the context of what we've been talking about and random walk down Wall Street, I mean, can investors beat the market, or is it just picking the right market at the right time?
Well, investors can definitely beat the market. That's not a question at all. You can beat the market by active indexing, just by loss harvesting and taking the index pre-tax.
Is that really beating the market, or is that just kind of using a strategy to eke out a few percentage points? When I talk about beating the market, I really mean like beating the market,
if the market goes up, remember, it's not the headline number of your return. It's what you get after fees and after taxes, right? And so there's no more sure way to beat the index than to do active indexing, or what's now called direct indexing. It's almost guaranteed that you'll beat the market. Your return after taxes should be higher than if you just bought the ETF, if you're a taxable investor. In emerging markets, I think it's absolutely possible to beat the market, but just by leaving out the state-owned enterprises, right? I mean, there's an ETF that leaves out the state-owned enterprises, and it's done a lot better than the one that includes them. And I probably am the best salesperson for it because I talked about this for 5 years before they even launched the fund. I should have done it myself. So in emerging markets, there's definitely ways. The EMQQ, the Emerging Markets Internet Index, has beaten the index by about 5% a year since we launched. Now, we also had a huge bubble at one point, and so there's been some rough period. You bought day one and you own it until today. You beat the index by 5% a year so far. So I think in emerging markets, yes, but you got to get more targeted. I am absolutely convinced that the emerging market internet sector will beat the emerging markets broad beta, and the India internet will beat the MSCI India so on and so forth.
How about this question? Can VCs beat the startup market, or are they just randomly walking down Sand Hill Road?
Well, I think by definition, the answer is yes, they can. And they also probably have a higher chance of not.
Higher standard deviation around the mean.
Yes, I guess that's the way that it would be expressed mathematically. There's some big winners out there.
Yeah. What's the biggest mistake U.S. investors make when they're looking at emerging markets like India or China?
Boy, well, the biggest one is they just buy the iShares or Vanguard version. I mean, again, there's just a disconnect. People think, oh, this is the same thing as the S&P, but it's the, these companies in India or whatever. Again, it goes back to the very basics. The reason companies have value is because they grow their earnings. And to grow your earnings, you should grow your revenue. I mean, in the long term, you need to grow your revenue. But that's what makes companies more valuable. And if you just buy the index, if you look at what they haven't done either of those things. So that's why I know you can beat the emerging markets index. That there is going to be more volatility in things like the internet companies. But I think that this emerging market internet stories, it's just getting started. And we've beaten the broad index by, again, about 5 points a year on average over the decade. But that's after a massive wipeout in the Chinese internet stocks, which have been our, the biggest part of what we do. We've still beaten the index by a lot. And I think the next 10 and 20 years is going to be the sweet spot, is this story that has already happened in China as it spreads to the rest of the emerging markets, because they've got 5.5 billion people and China's only got 1.5. So the third wave is the way to go.
What's a metric that if you're looking at an emerging market, that you look at to know whether or not it's investable?
Well, the only multiple that makes sense for investors in my mind is the PEG ratio, the PE divided by the growth rate. It's the earnings that make companies valuable. And so, people that tell me, oh, it's got a PE of 40 or a PE of 50 or a PE of 10, that doesn't mean anything without the G, right? There's no way to determine if that's a good number or a bad number. That's a big mistake with investors. They see a high PE, they go, oh, it's 35 times earnings. I remember the first time I looked at 10-cent stock 20 years ago, and I thought, oh, gee, this is too expensive.
It's really about it's what kind of PE you're getting for a given growth.
It's the only way to measure because you're buying the future. So the slope of the curve matters. So a PE of 50 for a company growing its earnings at 60%, that's, might be a bargain. So the PEG ratio is what I would look at. And of course, venture.
What's a good rule of thumb there if I'm looking at like Vietnam or Thailand or, Indonesia or some other emerging market?
Well, I think you still have, it still comes down to the individual companies. I mean, that's the, I don't know what specifically is in the Vietnam or Indonesia index, but I'll assume that it won't be things that you should buy. The biggest positions are probably banks or companies, government-owned things, legacy
not things
economy.
that are going to get big fast, right?
Yeah, and but another thing which I didn't really, most of the internet companies that I've mentioned, they're not even in the indexes. Mercado Libre, the single best performing stock in all of Latin America, it's not even, and it's the largest company in Latin America too now. It's not in the Vanguard Emerging Market Fund. Petrobras,
why did they leave it out?
Because I don't know. I'm not in charge of MSCI, but there's this one thing that's a kind of a problem, I think, in the investment business is, especially as indexing and ETFs have taken off. You go back to, how does this happen? You got S&P and MSCI and Dow Jones, and these people make a list, okay? It's basically a spreadsheet. Here's all the companies in the index. Now, this is not Google Labs. If you go down to visit S&P at 55 Water Street in downtown Manhattan, this is like going to the Department of Motor Vehicles, cutting edge stuff. And they're going to take that list and they're going to email it to iShares and Vanguard. And those people say, thank you. And then all they do is try to replicate the list as close as possible. There doesn't appear to be a lot of questions like, why don't we own the single best performing company in Latin America, Mercado Libre? Why?
Because they should be asking themselves that question.
I know they don't ask them. Apparently, they don't ask you a lot of questions. I mean, I've been asking the question for a long time, but Baidu wasn't in the index. When Alibaba went public, it finally was. I talked about this for years and years, like how stupid this was, that Baidu wasn't in the index. When Alibaba went public, there was so much hype that somehow the USA Today and Consumer Reports both ran stories about this. And they said, with all this hype around Alibaba, it's not going to be in your Vanguard fund. It took 3 years for them to change the rules to include the Chinese companies. But the Southeast Asian companies, the Korean internet leader, Brazil's internet leader, none of them are in the index. Anyhow,
Last question. So what's a book or resource every emerging market investor should read?
I haven't written it yet.
I love that. Well, where can folks find you online, Kevin?
Our business website is EMQQ, as in emerging markets, QQ, like the Qs for our technology stocks here, EMQQ Global, global.com, or, of course, on LinkedIn.
Of course. Thank you so much for coming on. Really fascinating.
Thanks so much for having me.
Thanks.